Do you think that you're going to be able to afford college for your kids? Well, I can tell you that is one of the biggest questions when it comes to financial planning that many of my clients really do struggle with. So today we are going to be discussing in our Tuesday tips education funding. So definitely stay locked in. Hi, my name is Carson Graves, certified financial planner and president and CEO of the Retirement Education Center. And I want to welcome you once again to our Tuesday tips, where today we are going to be talking about education funding. Now, we all know that it can be a great burden when you're trying to pay for college for your kids. One of the biggest political issues that many of the politicians are having to face right now is the rising cost of college and the amount of debt that it takes for many people who go to college are having to be faced with. So today we are going to be discussing some education funding options and how you need to go about thinking about planning for this huge expense. So let's go ahead and get started. Now, when we're talking about education funding, there are questions that you got to answer, and you have to answer these questions in order to develop an effective savings strategy for your education funding. So when I'm discussing education funding with my clients, there are three questions that I always have to make sure they understand they have to have an answer for. There are many, but these are the three questions that you need to make sure you lead with. One, where will your kid go to school? Is it going to be an in-state school or an out-of-state school? Is it going to be a public school or a private school? Two, how much will it cost? And three, what's going to be the best way to invest in order to pay for that cost? These are the three questions that you're going to need to be answering before you start any type of saving strategy for education funding. Now, once we have those questions answered, it is my job as a certified financial planner to make the steps simple. That's why we do this channel. We try to keep things simple here. How do we make the process simple? Well, one, we have to make sure that our clients identify the future costs of the education in which they want to provide for their kids. Now, most studies will show that the average education inflation rate is twice that of what the actual inflation rate is for the economy. It's going to be 6%. That is the average education inflation rate that is actually projected by most financial advisors. Now, with that being said, the second step in this process is then to identify what appropriate savings vehicles are going to be available for this client. Now, this is probably going to be the most complex issue to address because there are so many different avenues that you can take when it comes to education funding. But that's my job, to figure out what it is that you need to be doing. The third step is really getting educated on whatever the potential tax credits that may be available for your student. Now, here we may have to coordinate our information with your particular tax advisor because we do not give tax advice. Now, there are two potential tax credits that most people need to become familiar with. One is the American Opportunity Tax Credit, where each qualified student can get up to $2,500 per year. And then there's the Lifetime Learning Credit, where each qualified student can get up to $2,000 per year. Now, if you're taking a look at the average annual cost of college, this is from 2022 to 2023, as you can see, for a 4-year in-state public college, the average annual cost is going to be almost $28,000 a year. If we're talking about a 4-year private institution, we're talking about over $57,000 a year. So if you're actually doing any type of college projections, you can assume that if you have a child born today, 18 years from now at an inflation rate of 6%, you're probably talking about college for a private school at least, anywhere between $300,000 to $600,000 to send that kid to school for 4 years. So you can clearly see how a cost of that amount can give anyone anxiety about trying to fund college for their kids. So once we finally figured out where we're going to go, how much college is going to cost, we now need to understand what type of vehicles are going to be available to us. Now, when we're talking about different type of saving tools for college, you have to make sure that you look for a tool that's going to have both a tax and financial aid advantage. It has to be both. It can't just be one that has a tax advantage, but maybe affect the financial aid that could be available to the student. So let's discuss the issues with financial aid and why it's so important that you understand how to integrate different financial tools that will not affect the student's financial aid ability as well. Now, when we're talking about financial aid, it's really going to be determined how the assets are owned. This is what's really important. Is it owned by the parent or is it owned by the student? Any asset that you're using for your education funding for your child should be generally owned by the parent, not in the child's name. Why? Because when it comes to financial aid, about 20% of the assets owned by a child would be considered available for college. That means that that's going to affect their financial aid ability. Now, when it comes to assets owned by the parent, less than 6% of those assets would be considered available for college. That's a huge difference. So that's why we always are going to make sure that whatever tool that we're going to utilize for our clients is going to be owned in the parent's name. Now, with that being said, what education saving options are available out there? Well, there are many, and we're going to talk about two of them today. You can look at private investment accounts, like money in a brokerage account. You can fund a custodial account. These are known as uniform transfers to minor acts and uniform gifts to minor acts. So we can talk about these two accounts, and we will today. We're going to talk about these two only. You can also do a Corverdale education savings account. We're going to talk about that in part 2 of this video. Of course, many people are familiar with the 529 plans, and one education savings option that may get overlooked would be a Roth IRA. So we are going to talk about these 3 education funding options in part 2 of our education funding video, because I think it's really important that we're able to understand this without having too much information thrown at us. So when it comes to the education funding options that we're going to be discussing, we need to know the advantages and the disadvantages. So first, let's go ahead and talk about the private investment accounts. Now, these are going to be the most tax inefficient option. This is going to be money like you put in your brokerage account. But there are advantages to actually putting money into a private investment account for education funding. One is that you have unlimited contributions that you can make to a private investment account. Obviously, there are no caps on the money you can put into an individual brokerage account. You can put $2 million in there. No one is going to stop you from doing that. Another important advantage is that you can control your assets. You, the owner of that private investment account, you maintain complete control over those assets that you put in there. And you have great investment flexibility when it comes to the private investment accounts for education funding. So you can put in real estate, you can put in precious metals, you can invest in options, you can do pretty much anything you want when you're talking about investing in a private investment account or a brokerage account to help fund your kids' college. But of course, there are disadvantages when you're talking about a private investment account as well for education funding. One is going to be the lack of tax benefits. Now, I mentioned earlier that this is the most tax inefficient option, because the earnings and the capital gains in a private investment account is going to be taxed at the capital gains rate or the state income tax rate as they are realized. So when you're needing that money for college for your kid, when you have to sell out of those positions, you're going to have to pay taxes if there has been any increases in the overall positions that you're selling out of. Now, with that being the case, other education savings alternatives do offer tax-deferred growth. They also offer tax-free withdrawals for qualified expenses for education as well. So this is going to make other vehicles when it comes to education funding more attractive than putting money into a private investment account. Now, when it comes to the student aid impact of having a private investment account, this is going to be considered favorable. Why? Because the parent owns that account. It's not going to be in the student's name. So that's a plus. But there are some disadvantages that you're going to have to understand if you're going to go this route in funding your kids' education. Now, our final education funding account that we're going to discuss today is going to be custodial accounts. These are going to be the UTMA accounts and the UGMA accounts, the Uniform Transfers to Minor Act and the Uniform Gifts to Minor Act. Many of my clients utilize these types of accounts for their kids, and many grandparents also use these accounts for their grandkids. Now, when it comes to custodial accounts, the mechanics are going to be that there's going to be a donor, someone who actually funds the account. It's going to be a custodian and a beneficiary. Now, the donor is oftentimes going to be the parent, and the parent is going to be the custodian as well. Now, but it could be a grandparent that has his account open and fund the account, and the parent can be the custodian. You can name whoever you want to be that's an adult to be a custodian over these accounts. But the beneficiary is going to be the child. Now, with this particular type of account, there is a really unique tax that could be associated with it. This is known as a kiddie tax. This can be a disadvantage here. Now, the kiddie tax is basically any unearned income above $2,500. It's indexed every year, but it's in 2023, anything above $2,500 will be taxed at the highest tax rate of the parent. So it can be taxed as high as 37%. If the parent tax rate was 24%, it'll be taxed at that rate. If it was 22%, it'll be taxed at that rate. But just understand that any unearned income inside of a custodial account above $2,500 will be subject to this kiddie tax. So that can be capital gains, dividends, interest, that's unearned income. When it gets above $2,500, just know it's going to be taxed at the highest tax rate of that parent. Now, when it comes to the kiddie tax, it's going to be unearned income for the beneficiaries who are under the age of 19 and dependent full-time students under the age of 24. So under the age of 24, if they're a full-time student, that beneficiary may possibly be subject to the kiddie tax. Now, with that being said, there are some advantages to doing a custodial account. Like all products, there are pros and cons. Now, one of the advantages when we're talking about using a custodial account is that the parent will have the control for a moment. And with that control, they can name whoever they want as the custodian. So whomever you want to name, you can name a sister or brother, you can name an aunt and uncle, but you can name whomever you want to be the custodian of this account, just in case anything happens to you. But like I said, typically it's going to be the parent who's the donor and the custodian. Another important advantage is that the custodian or the parent will control this account until the child reaches the age of termination. And we're going to talk about that in just a moment, what that is. Now, there's also, we mentioned the kiddie tax, but there's also a potential tax advantage to the kiddie tax because any unearned income below the $2,500 in 2023 will be taxed at the child's low tax rate. So basically, when you're talking about the unearned income below $2,500 as it pertains to this particular account, the first $1,250 of this income when it pertains to the kiddie tax will not even have any taxes attached to it. So it's taxed at a 0% tax rate. The next $1,250 will be taxed at the low child's tax rate of 10%. Now, of course, anything above that, that's when we get into that kiddie tax that's going to be unfavorable because it'll be taxed at the high parent's tax rate. Now, with that being said, there are some disadvantages to doing this particular account for education funding. We must talk about it. Now, as we mentioned, the parents will have control, but it's only to the age of termination. So as many people might say, the same thing that makes you laugh can make you cry because you do lose control over this particular account once that beneficiary reached the age of majority. That means you no longer have any say in the money. And in most states, the age of termination is going to be either age 18 or age 21. You have to check with your state. But just imagine if you have, a lot of money in this account, when that child reaches the age of 18 or 21, they can do whatever they want to do with those funds. Also, there is a limit on the contributions to these types of accounts because this type of an account, when you put money in, can be considered a gift to that child. And therefore, you may have to come to bats with gift taxing. Now, for 2023, the annual gift tax exclusion is $17,000. So if you were to put more than that inside of this account on an annual basis, you may be subjected to a gift tax. Now, you do have a basic exclusion of $12,920,000. So yes, you might be subject to a gift tax if you're an extremely wealthy person. But if you happen to put like $20,000 in this account, I don't think you're going to have any problems because you can then tap into your basic exclusion amount and virtually not pay any taxes on that amount above $17,000. But it needs to be noted that that is an issue that some people may have to couple with when they're trying to put money inside of an account like this. And then there is one last disadvantage that I want to discuss, and that's the inability for you to change the beneficiary. Now, unlike other education savings vehicles where you can actually change the beneficiary, when you're talking about setting up a custodian account, a uniform transfer to minors or a uniform gift to minors account, just know you will not be able to change that beneficiary. The beneficiary will remain permanent once that account is open. Now, what is the student aid impact when it comes to a custodial account? It is unfavorable. Why? Because you don't own the account as a parent. Yes, you are the custodian, but the beneficiary actually owns this account. And when they get to the age of majority, that's why they can take over this account at 18 or age 21. So if you're talking about the student aid impact, this is not the type of an account that you're going to want to set up for your child for education funding. So I really do hope that part one of our education funding video was beneficial in helping you understand some of the options that you may have to fund your child's education. Please note that these videos are created for educational purposes only, and that you should always seek out your own financial advisor, your own tax advisor, and your own attorney regarding your personal situation. Also, if you're looking for a fiduciary advisor to help you with these types of complex financial matters, we highly recommend that you reach out to our office and go ahead and schedule a 1-hour free consultation with us today. And if you found this information to be beneficial, all that we ask is that you subscribe to our channel, like this video, and share it with others.